The week started with a whimper today. Very, very boring day today. Not a lot of trading, not a lot of volatility, at least in the S&P 500. The Russell 2000 still pricing in this idea of tax reform, so that continues to be a big driving force. You see a lot of debate going on right now about the merits of the tax plan. From a market perspective, we're going to break down how it's reacting and what to expect, either whether it passes or not. And then today's trade idea, because of how there's not a whole lot going on, we have to be a little picky and choosy about what's going on. So I'm going to break down a good technical setup from a longer term perspective and see how we can take advantage. So let's go ahead and get started. Today is Monday, November the 20th, 2017. My name is David Settle. This is my market outlook for today. Thank you very much for watching. I appreciate your time here tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel. Hit that red button down below the video. Also, click the thumbs up. Let me know that you liked it with one click. Very, very easy way to give me some feedback. Scroll down to the very bottom of the page. Comment in there something that you took out of today's video, and also in the description there's a link to join my daily email newsletter. Click that link and subscribe. Follow me on Twitter. My handle is on the screen at DavidSettle42. There at the top of my feed there's today's market outlook tweet. Like and retweet that if you feel like other people should check it out as well. Alright, well, let's take a look at the S&P 500 with the market forecast indicator. You can see we're going sideways heading into the holidays. A holiday week. Lack of news really for the week. Everybody looking ahead to this tax reform, so we're stuck in a really small trading range. Stuck within the range. Remember, we talked about how, you know, this day right here, was that'd be Thursday, we probably pulled forward a few days worth of gains, and that's why we're not really doing anything these couple of days, because it all happened on Thursday. We came up, we gapped up and went up so high. So that's really what's happening here. Now you have a bearish posture still. It's weak because it's still, what, at 68th percentile? Almost 69th percentile. The momentum line is down, but it's not down to an extreme low, and which is what you look for, something like that. It's got to be below that 5th percentile before you say, okay, you know, now we're really worried about, you know, this bearish trend continuing in that case. So the near-term line avoided the upper reversal zone. So that's something to keep an eye on too, the fact that it can't get up there. If it comes back down below 50, you can consider that a bearish near-term high point. And, you know, obviously it came down today. We'll see what happens heading into tomorrow. And so, you know, that's what you have. And this is, you know, this near-term high point right here, which is right there based on, again, the near-term getting above 50. It would be a lower high point. So, you know, and you've got a little bit of a, you know, you can kind of see with the ovals, a little bit of an inverse, or excuse me, a head and shoulders pattern developing on the S&P 500. So we'll keep our eyes peeled on that. The idea was that we expected a bounce, a near-term bounce off of this bullish near-term low point here, slightly bullish, slightly higher low. That would get into this area, that could possibly get up to new all-time highs, but would, you know, not significantly new, and so we wouldn't put a whole lot of stock into that. And the idea that we'll get more of an intermediate term pullback eventually, you know, probably sooner rather than later. You know, that's what we were expecting, and so far that's kind of playing out. Like I said, more of a bounce on Thursday, and we talked about the idea that we probably pulled forward some days. And that's why, you know, you take that out, and we're kind of gradually moving up to this point to where we are today. And probably could get another day or two heading into the holiday for that matter. And then, remember, we get the half day on Friday after the holiday, and then we start, you know, then we have December and we head into Christmas. Now, typically, this is a bullish time of year, but this isn't typical year, right? Number one. And number two, not that we can dismiss that, because again, it's like, you know, wintertime, it's cold, and here in Utah, it typically snows. Now, some years it might not snow. Some years might be warmer than normal, but you still can't go into winter saying, well, okay, well, we were colder than normal in the summer, so that means we're going to be warmer than normal in the, you know, we can't expect snow in the wintertime. No, you just expect what the seasonality brings you. And so we're going to, you know, the idea is that there's bullish and the long-term trend's there. The difference, though, heading into this year, and you can kind of look at like maybe like El Nino type effects, so to speak, and how that can impact seasonality. The El Nino effects here are the fact that we've been so bullish in the long term, and that we're consolidating right now. The market sentiment's high, the intermediate posture is consolidating, these moving averages are consolidating, and that can impact and maybe cause us to have a little bit warmer than normal winter time. When this idea that December and January tend to be tend to be pretty bullish on the normal seasonal pattern. We'll take a look at the Russell 2000, and you can see it's been doing a lot better. Again, a lot of this bullishness has been due to tax reform related hopes, right? House passing, that's why we jumped up there. But you notice the Russell's really gained the last couple of days, and the S&P hasn't. So those hopes, which are geared right now to the small cap, the high yield area, that's not coming through on a broader level yet. The S&P, still wants to see some, it needs to pass in the Senate, number one, and number two, they need to come together for something that everybody can pass, eventually, after the fact. So a lot of the small caps, you can see there's a lot of hope right now heading into that tax reform process, and that's why we see such outperformance here. And then we're pretty much getting close to all-time highs again on the small cap index. The near-term line's firmly established in that bullish zone. The intermediate line's close to crossing above 50 again. But unlike over here, where that happened, the near-term line got in the reversal zone, market sentiment crossed above 50, or over here. Here, the market sentiment was down. It was down below 60. It was at 50. We were at a low point, and then it turned up. Here, not at a low point. So that's why this may be a little different than this, what we saw over here in late August into early September. Alright, so we take a look at the long-term view, and you can see we're still above the 50-day moving average, and the momentum is still strong. It's still up above 100 points, even though the last couple of weeks have been down weeks. I did tweet out, last week is the first week that we've had with a lower high and a lower low in quite a while. So even here was a lower high but a higher low. So it was really back in August here, the last time we had a lower high and a lower low and a lower close on top of all that. So that's what we had here. It was barely a lower close. In fact, we finished the week higher than where we started the week because of the gap down. So not that bearish. But I tweeted out a pretty decent article where they have data in November's, again, looking at the seasonality of when this occurs and how bullish that can be, through the rest of the year. Now, again, grain of salt because of, how the market forecast is shaping up. But don't automatically say, okay, man, we're so bullish in the market forecast, we have to start coming down and forget about this end of year seasonality. The trend is still bullish, that seasonality is still there. We might not have as big expectations, but we still need to take it into account in terms of how we trade and how we position size. Following the trend, following our expectations, managing risk differently though, because of how the market forecast is set up to where we're not nearly as aggressively bullish, and we're trading probably smaller than normal just in case this technical setup, which is overbought, overextended, doesn't mean it has to roll over, but if it does, because of how overbought and overextended it is, whatever catalyst comes to pass that causes a sell-off, that causes kind of a return to the mean, then it won't hit us as hard because we're not so loaded up and aggressively bullish with new positions now. Yeah, we can get more aggressively bullish in some of these other areas, but not now because of how that picture is set up. We look at the 3 green arrow chart here, and you can see we still got the 1 on the move. We're still easily above the 30-day moving average. We're still above the 8-day moving average today with the close, holding the 17-day as well. So, but you also see that MACD, while it has slowed its descent down and has been moving towards its moving average, which is why the histogram is rising. I don't expect it to necessarily cross above that without getting closer to 0 here. So that's why I think we can bounce up in this area, maybe stay above it a little bit, maybe bring that up to just a little bit above the moving average, get like this weak green arrow. I don't expect it to take off though like this into a new extended bullish run on momentum. You got both the MACD and the stochastic still below their downward sloping moving averages. All right, taking a look at the intraday move, you can see very, very small range again, slightly higher high, slightly lower low, but still stuck in the range. Pretty much stuck in the range that we had on Friday. Not much of a move at all. But you can see something that's kind of developing here. The last week's range, here in another day, like once we get this moved out of here, then the 4-week range is going to move up to last week's low point. And the last week's high is just a little bit under the 4-week high. So in other words, the last week's range, which wasn't just what, about 4.5 points maybe. Last week's range will pretty much be the 4-week range, and that's a tightening range. Now, of course, we can break out to the upside, but the expectation is when that range tightens up as much as it has, and it has really been tightening up, right? Because you can see, over the last little bit, the range has been pretty wide, and you see now how it's starting to tighten up here. When it tightens up like this, we usually break out of it to the downside. Now, we can stay in that range for a while, so it's not like an immediate breakdown to the downside. But again, another one of those technical evidences that's setting up for, this expectation of more of a downward move, more so than an extended upward move. Now, and of course, anything can happen, right? That Senate passes a tax bill, and the market loves it. We could go up to the upside for all we know, right? Anything can happen. But just from a technical perspective, looking at what we see on the charts, the environment is being set up for more of a pullback down to the downside. And again, not necessarily to a strong bearish long-term trend, but at least kind of pulling back some of this long-term upward move that we've had. If I were to take a look here at the range today, again, not very much. 2/3 of a point. Smaller range than what we had on Friday. So 2/3 of a point. The volume at under 50 million. Put that in context. 2/3 of a point is extremely low. Under 50 million, extremely low. So both of those signs. We're just kind of grinding on this near-term move higher. That's why we're not looking for a big upward move here, because we're already to the point where look at volatility. Look how much volatility has dropped in just these last couple of days. After that big bounce, and then Thursday's move, and then Friday, and volatility, bounce of volatility, and then now today, we've dropped from 13 down to 10, just like that. And on a ratio basis, you can see we're already back down to 80%, which is an extreme level to the downside, so extreme low for volatility. Now we can stay down if we get below it and we kind of hover around there like we've done before, then we're going to grind higher, slowly higher into the end of the year. But if we, typically when we get to this extremely low, we bounce. That volatility bounces, and that would be, you've got that low point here, that kind of, that area. There's the last one before that. Before we came down, we got below 10, or got around 10, and traded around 10 for a while, and the ratio got below 80%, traded around 80% for a while. If we don't get below this 10.5 and use this for a support now, which was the high point during that area, and bounce off of that, which is probably about 50%-ish of that move, and then the ratio bounces off 80%, again, that would coincide with a break below that 4-week range to the downside, more so than a break to the upside. And if we do break to the upside, considering how low we already are in these levels, it will just be a slow grind to the upside. Alright, now let's take a look at what's driving this price action today. Not very much on the calendar. Everybody's still kind of focused on this tax reform. Remember, it was a really light trading day, so not a lot of movement. Indicators, economic indicators are still pretty strong. The odds of a rate hike are still pretty much 100% by December. Never fully 100%, but really high for December. And you can see now by next June, the odds of 2 rate hikes, we talked about this Friday, the odds of 2 rate hikes are almost as high, which is this gray line, by 2 rate hikes more, like in addition to the December hike. So one in March, one more in March, and then one again in June, are higher than not having any at all in 2018. So again, the odds of a rate hike in December are baked in the cake. So we're talking about what are we looking like in the first 6 months of 2018? So the odds of getting 1 are above 40%. The odds of getting 2 are above 20%. So at least getting 1 is now up over 60, getting close to 70%. The odds of not getting any at all have dropped down below 30%. So we're getting pretty good odds. We'll get at least 1, and the odds of getting 2 in 2018 are getting higher and higher because of this. I mean, the economic indicators, at least from a sentiment basis, are really high. And of course, we know what the valuations are looking like in the stock market, and that's kind of what at least the Fed is kind of considering, as they approach, what they should do heading into a new year. Now, we take a look at what's the major asset classes and how they performed today. Right off the bat, the dollar was strong. International stocks did okay, but usually they do okay when the dollar's weak. In this case, the dollar was strong, and stocks still started the day slightly positive. And you can see Treasury started the day down, so that's higher yields. And gold and oil started the day down too. Oil recovered off its low, gold didn't. So gold was pretty much the one big outlier to the downside. On the other hand, risk assets like stocks, number one, and then of course small cap stocks and emerging market stocks did really well. Interestingly enough, the S&P 500 did the worst out of the 4 when you include developed markets, international markets as well, and both of these underperformed the dollar. So kind of an interesting move today. The dollar was strong. That helped out these. Emerging markets typically don't do well when the dollar is strong, but they still performed well. And of course, we know why small caps and high yield are doing okay is because of this tax reform. Now you notice high yield didn't do that great. In fact, it finished pretty flat. It outpaced treasuries, but not by much, and it wasn't up very much on the day. So again, that's kind of why I'm saying, small cap stocks are loving these tax reform expectations. Not everybody else is quite yet. So that's why I wouldn't put a whole lot of stock into that. And of course, if for whatever reason this doesn't come to pass, this fiscal reform doesn't come to pass, then we know what's going to happen, right? We know what's going to get hit hard, especially in that small cap area, which had been underperforming until last week, and has done really, really well. In fact, over this 3 days here, since that news came out, since the House passed that bill and that news came out, you can see, large cap stocks are up 0.75%. Small cap stocks are doing much better. And you can see emerging markets doing really well too. The dollar was down heading into today. And of course, the strong dollar pushed gold finally down. And basically all your safe haven asset classes are down. And your risk asset classes have really taken off. And again, a lot of that's based on that fiscal reform expectations. If for whatever reason that doesn't come to pass, we know the trade. There's the trade. It's the opposite of this. So we're going to know what the trade is. Crude oil kind of does its own thing, so don't bake a whole lot into that one. But we know what else what's going to outperform, what's going to underperform. So I got the sector chart up here, and it's on a daily chart, but let me zoom back out again to this last 3 days where small caps have really taken off and large caps have gone up a little bit, 0.75%. But here's your biggest gainers during that move: consumer discretionary and consumer staples. Thank you to Walmart, right? Walmart over here, Cisco. They're holding some of those gains. Materials are up too, and consumer discretionary. So those here, you can see that the sectors that are performing the best have been kind of earnings related, whereas on the other hand, again, this idea that higher interest rate hikes better for the financial sector, but the problem is that yield spread. The financial sector is kind of banking on a wider yield spread. They're gathering assets, expecting to be able to make money on all these assets once yields rose. But the problem is short-term yields are rising, but long-term yields have been falling. The longest-term yields especially have been falling, and that's been making the yield spread itself, while not necessarily so a falling yield spread is not a bearish indicator. An inverted yield spread can be. A falling yield spread actually is a bullish indicator. The markets rally when the yield spread is falling. So even though it's at a low level now, it's still falling. So that doesn't necessarily mean the market's tanking. There was a good article I read over the weekend on that too. And of course, there's been a lot of articles on the on the coaching corner, the blog, way back when. One of my colleagues wrote a really good article on that. So a falling yield spread doesn't tell you, man, the market's got to start tanking. No, inverted yield curve, yes. Once we get to that point, because that means short-term yields we pushed them up too high, because short-term yields are dependent upon Fed policy. Long-term yields are dependent upon economic growth expectations. So as long as they're both going up, then yield spread's wide. Great, financial sector's doing well. You can see the financial sector's not liking the yield spread right now. Energy stocks, not surprising. You can see utilities are down during this run-up, and you can see too that healthcare and real estate are underperforming. So those are your safe haven sectors. So it's been a risk on kind of a move, but it's been very picky risk on. It's been more small cap and earnings related. It hasn't necessarily been broad market, your typical bull market sectors. I mean, you do have technology and this discretionary leading, but you also have staples up there too. And a lot of this leadership, you can see even technology. I mean, just looking at today, here, there's your broad market. Yeah, financials, technology, discretionary, healthcare is bouncing back up a little bit. There's your safe haven areas down here. Excuse me, not healthcare, industrials, materials. I mean, these are all bull market areas. Great. Not a whole lot of outperformance here. Not a big gain either on a really small volume day, small trading range days. So we'll kind of see if there's any follow through to this. If we are going to be bullish, if we are going to get with that seasonality, kind of overcome this really overextended market forecast picture, we break out of this tight trading range to the upside, this is what's going to lead the way higher. If we start to pull back, this is what's going to lead the way lower. And you'll see because these have dropped, especially like utilities. Utilities had been so bullish, you'll find that those areas won't fall as much during any kind of extended pullback. Alright, now with our trade idea of the day, let's take a look at, considering again the lack of news on the calendar and very, very small range. Let's take a look at a stock I've got pulled up on the screen that's been in the news lately, mainly because one of its main titles, gamers haven't been too pleased with. But if you also notice too that it's, we had gapped up on an earnings 2 cycles ago. We've touched that area at 105 a few times. We're pulling back down now. Now, one thing to keep in mind from a technical perspective, take a look here at the long-term chart. You can see, the 50 is above the 200-day moving average. We've pulled down. We're pulling down towards it. In fact, price has come down, and now it's looking like there's some support potential at the 200-day moving average. If you take a look at the last few years, in that 5-year period, you notice at the end of every year, we've kind of had this cycle where we pull down to the 200-day moving average. Now it might, here in February we had a little bit of a downturn, and here it held, but didn't really bounce very fast. Here it was more in the summertime before we bounced sharply into the end of the year, and here it kind of came around and fiddled around with the 200-day moving average before bouncing. And so we can say, okay, well, it looks to be kind of a similar pattern that we have. And when you take a look at, it's outside that Bollinger Band. But another thing to take a look at here is that linear regression trend line. We are outside, because of this pullback, we're down below 2 standard deviations away from the best fit trend line here, which is above 125 right now. So we're well below the mean, so to speak. And that doesn't mean we have to jump up to get to that, but it does mean that, man, we've really pulled back here, according to the trend, quite a bit. So we can say, okay, well, we know that there's some support at 105 because of the gap and because of the multiple tests of that level. We're approaching that. There's a 200-day moving average there too. There is this linear regression trend line. So if we say, okay, what if we just went out to the 60 days out here? We can go earlier. The problem with going early right now is there's not a whole lot of the bid-ask spreads in these weekly options are not very, they're pretty wide. They're a lot wider than what we even see here. But if we go back out and sell that 305, You can see this is a 35 cents, so it's about a 10-cent spread. And buy the 100 for protection. And again, you have to fiddle around in here with the pricing because they're wider, but the price is higher, so we have some room to work with. And you're getting a little bit more credit than normal for a $5 wide spread at a 38 delta for the short strike. So we can say, okay, well, if I were to sell that, then I can look for an opportunity for it to hold that support and make a little bit of money off of it. Assuming, again, the normal trend holds, or we pull back to the 200-day moving average, we might go around sideways, bounce up slowly. In this case, because of the trade, we don't really care if it goes sideways or bounces up slowly, because the delta is really small. You got a 4. Well, let's set that slice to the current price level here. You got a 15 delta. You got a positive theta, so and you can see you'll have positive theta even if you came all the way down below 105 into this 103.5 area. So you got a lot of room to work with before you hit support, and even a little bit below support. And of course, if it breaks below 105, then we'll just take whatever we're trying to get, a $143 gain. You can see right now it's at $58 loss at 105, 56, 57. That number is going to get gradually higher, because that purple line comes up to this green line as time passes. It will go down below that. So we just have to be willing to say, okay, if it does not hold 105, we'll take a small loss in this area right here. If it stays above here, then we'll take that gain, and there's my profit to loss ratio, which, when you look at max gain and max loss, isn't very good. When you look at max gain compared to what loss we're willing to take, then it doesn't look that bad either. It looks like a pretty decent trade from a technical perspective, from a long-term technical perspective, where there's multiple support levels lining up, as well as recent patterns of seasonality, of weakness heading into end of the year, into that 200-day moving average, and then the past precedent to hold that and bounce even just a little bit. So in summary, the market still shows a bearish posture, a weak bearish posture. The Russell 2000's bouncing quite sharply, mainly on tax reform hopes. So that's what the market's looking at right now. Not a whole lot of news from an economic standpoint, even though the news that we've had has been very, very bullish, and is starting to bring up those rate hike expectations. But from a technical perspective, we've been very strongly bullish, and the question now is, if we continue to go up, how much further are we going to go? That kind of limits our expectations, dampens our return expectations, and then tells us how we should start looking at new positions in this environment compared to a more aggressively bullish environment. And that's where our trade idea says, okay, in a lack of news, let's take a look at an opportunity that's developing from a long-term technical perspective on a stock that is heading into some multiple layers, showing weakness, heading into multiple layers of support, and we'll see if we can't sell a put to take advantage of that and reduce the cost basis, reduce the margin requirement for selling that put by buying an out-of-the-money put, giving up some return potential, but also capping that max loss, and then looking at the trade instead of a max gain and max loss perspective, saying, okay, we're going to be willing to take that. If we break 105, we'll take that small loss, and now I have a much better profit loss ratio as a result. Okay, with that said, thanks again for watching tonight. I appreciate your time. Remember to subscribe, like, and comment on YouTube. Also follow me on Twitter, like and retweet today's Market Outlook video from there, and also join our daily email newsletter. Have a great one. We'll see you all tomorrow.